Hello, everybody. Michael Silva here. Hope you're all doing very well. We got some interesting stuff to talk about on today's Stock Market Brief Show. If you're new here, welcome to the show. We use technical analysis, intermarket analysis to get a good idea as to where the market might be headed. Next, if you haven't done so already, make sure to hit that thumbs up. It is greatly appreciated. The catalyst is among us, and I feel like people aren't really taking it that serious. Now, in today's video, we're going to be talking about what that catalyst could potentially be and what we've been seeing unfold behind the scenes in these marketplaces. And I'm talking about the debt ceiling. Ah, yes, the debt ceiling. When's the deadline? What happens if it's not raised? Failure to reach it on the government spending and federal debt could lead to a U.S. default. Not really the base case, but it seems pretty important. So important, why not just go ahead and postpone the meeting for early next week instead? That just came out from the Wall Street Journal. And we got Yellen over there saying that the drop-dead date for debt ceiling could be June 1st, which got people, well, confused. But don't take my word for it. Look at the market. This is the SPOOs, ES. The market has not gone anywhere, but yet all kinds of emotion, right? On this big up move here. Woohoo, it's going, and then crashed. Woohoo, it's going, and then flat. And then overall, what are we doing? We're still pinned between 4,100 and 4,200, seeing some wild swings. Yikes. But that's not all we're seeing. We talked about credit default swaps, the 5-year, starting to gain attention, even more so, right? We talked about how in 2011, leading up to the debt ceiling debacle, the debt ceiling crisis before the market fell 20% in 4 months, we saw that rise in credit default swaps, and we're seeing that again, almost to the level that we've seen in 2008. But what people are not talking about that much is actually the 1 year. Wow, take a look over here at the 1 year, right? That's much further above 2011 and even over 2008, 2009 great financial crisis there as well. All right, so we're looking at the U.S. government debt. You can see that we hit our ceiling, and it needs to be raised. You can see it actually more profoundly right over here as we're just kind of trucking along sideways. Now, this actually all took place at a very interesting time, and nothing's a coincidence here. So in January, right, January to February, right around here is when we kind of hit that debt ceiling. That was the same time that the federal funds rate went above the 2-year yield. Now, the 2-year yield is a good proxy on the federal funds rate, and if you don't know this, sometimes when the federal funds rate gets above the 2-year on a hiking cycle, that typically marks the end of the hiking cycle. At least it has for the last 30 years. And this took place the same time this took place, which is just about the same time, well, this took place. What's this? That's the banking crisis. Ooh, wild. If we zoom out further and we look at the 2-year in blue and then the federal funds rate in red, you can see the times where the red line got above the blue line. And that was right here in 2000 leading into 2001, right, that recession, right? And we got there also in 2006, 2007 area as well, and led to that recession. And you can see that when this happened, what did the federal funds rate do? Well, we ended up going down, okay? Even right here, federal funds rate, down, okay? That was in 2019 going into 2020. And then also, what do we see right here? Well, we're seeing we're seeing it take place right in front of our eyes. Now, what's the market typically doing during these times? Well, as we pointed out plenty of times, when the Fed stops the hiking cycle and starts reducing rates, typically something happens, and we've seen the market fall off many times. So if we look back at like 2000, the dot-com bust, and we look at the great financial crisis, right? When this happened, the market went around, like it gave us warning signs, but the market went up, but it was still important to note. And then, well, the great financial crisis happened, right? Then the dot-com bust happened, right? Then was it the pandemic for one, right, in 2020, but then also the Christmas Eve massacre that took place right there into 2019, all that repo stuff that was taking place back then. Okay, and now we're right here, and we're all talking about how it's potentially the start of the new bull market. I don't know. I feel like you got to be open to the idea, but you got to be careful. The catalysts are here. what happens with the yield curve? The yield curve is the best indicator of a recession ahead. And, well, when the curve uninverts, it's not uninverted here. Well, we saw, obviously, the great financial crisis. We saw the dot-com bust. And then this was during the same time where they reduced rates, right? And now we're apparently going to be holding rates steady, but the market is perceiving that the Fed is going to go off their base case and start reducing rates. Maybe they're thinking this because, well, the federal fund rate is well above the 2-year as the 2-year is backing off a little bit. Perhaps. Perhaps something breaks, perhaps something doesn't. Perhaps the Fed says, no, inflation's not at 2% yet. We're going to hold it here for longer, which could also be bad. A lot of volatility in the markets. It's crazy. And a lot of confusion, right? And that's why the market hasn't gone anywhere. You can see that they're trying to still reduce the balance sheet. It kind of went sideways this last report. You saw liquidity actually being added this last report over here. Other factors draining reserve balances, which could potentially help the S&P 500, but it's still a pretty big divergence as this has been heading down and the market's been kind of going sideways. Other note, bonds are doing quite well, right? The last couple of days we started moving up, but really we're just in this sideways chop. We recouped those moving averages as they're currently tightening up. We just see this coiling up action right here. It's like a spring ready to explode. And whether that's to the upside or downside, I don't know. But in my opinion, we're moving into that stage one, or we're already in stage one of the business cycle where you see stocks and commodities go down, which we've been seeing, and then you see bonds go up. Another thing to watch is the dollar. The dollar actually was bid today, still relatively flat, but it was a strong move to not see really much happen on the S&P 500. You saw assets like silver get crushed, right? But we talked about that and how it correlates to miners and so forth. You saw gold go down slightly there too. But you got to think about this. Bonds could be a flight to safety, right? If they start moving up. Dollar could be a flight to safety still if that starts moving up. And well, gold's been moving up, and that could be potentially acting as a flight to safety, right? It could be a little bit of a crowded trade right now. Might need to digest, but still, overall, if you zoom out and you look at the long-term chart of gold, it looks good, okay? So you have assets that are perceived to be safety, people going into those areas, all right? You have various different catalysts that could create more volatility in the markets, and then you just have a market that's sitting sideways and confused. And yet people are saying, with absolute certainty, the market's going up. Or with absolute certainty, the market's going down. Let me just tell you this. People do not know the answer of where the market's going to do, what it's going to do. We can only see what's taking place right now. What's taking place in the markets is one thing. What's taking place behind the scenes that we just went over in this entire video is a completely other factor. That's pretty much all I got for you. If you want to screenshot this, this is the daily expected moves because I'm not getting into the charts all too much today. These are the assets, right? And we track these on a daily basis in the Discord because they are very important levels to know. Like, for example, like the SPY today, right? It tagged its lower expected move. And if you didn't know that level, well, you know, you would just be kind of blind to it. It was an important level because that's where we kind of bounced from today on the SPY. So the daily expected move for the SPY is 2.81. That's plus or minus. The lower level is 409.32. The upper level is 414. And then this is the other products that we measure and map there. And then you have the 2 sigma levels there too as well. I share these on the Discord. I share them typically on the Stock Market Brief show here. I have links in the pinned comment and the description. I use software like Bookmap. They offer my subscribers a discount. And then I have the link to the Discord group, which I only charge $9 a month to be a part of. And I give all kinds of things in there for $9. Just ask around, see what other people say about it. That's all I got for you in today's episode, everybody. See you later.